Hello again, this is Alex with MasterChartsTrading.com, and this is market recap for Friday, November 25th, 2016. Again, we see in a parade of all-time highs and 52-week highs in the stock funds, and this is reaffirming my bullish posture. The rally, I think, can continue into the year end, and in fact, it will most likely be driven by underappreciated sectors like staples, utilities, and real estate. And the reason for that, I think, is because treasuries and bonds are showing signs of bottoming action. And of course, junk bonds are also near all-time highs, so this is good for stocks. We'll look at the Forex universe as it continues with a possible breakout, and by extension, gold is under pressure. We'll look at gold in some more details and compare it to the similar period, which I think happened in October of 95. So we'll look at also at oil and finish up with natural gas and copper, which I think is overbought right now. Okay, here is S&P 500 ETF SPY, our proxy for the market. This does include dividends, so it's a total return fund. We're seeing, and just on Friday we saw this gap and all-time highs. However, Friday was a short day of trading and there was no trading the day before, so it does make sense for it to gap up. And basically, this is showing that there is good appetite for risk. In fact, there is excellent appetite for risk because even at all-time highs, we're seeing a strong, um, hollow candle basically. Down below here we see an advanced decline line and advanced decline volume lines. Both are at all-time highs, and this implies that uh, there is really good market breadth behind this move. As of a few weeks ago, I thought maybe this breakout is not yet confirmed by the advanced decline lines, but I think now we can put that to rest, and we are seeing all-time highs and advanced decline lines as well. Additionally, there's this one market breadth index that I like to follow, this intermediate term breadth momentum oscillator. It's not yet terribly overbought. In fact, you can see here we were at around 200, we're right now at around 100. So there is room to run to the upside. In other words, even though these are all-time highs, and this was quite an impressive move, this was a bear trap and a move up to all-time highs. I think that, according to at least this indicator, there is still possibly more room to run for it to the upside. So I wanted to briefly go over some of the funds and sectors that are hitting all-time highs or 52-week highs, and of course S&P 500 ETF SPY. This is a weekly time frame. Total return index are all-time highs, and this was basically a bear trap and the negation, and we had a support break, and then support break was negated immediately. So market is bullish. I said that the market was bullish starting somewhere around here, around April of this year. So we could see further appreciation in prices. I don't know where it will stop. This is a bullish market, and it will continue higher until it no longer continues higher. The Dow Jones was actually one of the first indices to break out to all-time highs. 3 weeks ago, we saw all-time highs and continued higher this entire for the past 3 weeks as well, and yet again hit all-time highs on Friday. Very strong move in the small caps. IWM also hit together with Dow Jones 3 weeks ago, and just no stopping it for now. So we continue higher for IWM. The technology sector, QQQ, is showing a little bit it was a little bit underperforming compared to the rest of the stock market. Like I kept saying, it was a temporary underperformance because of the correlations between the major indices. is enormous. I think 95% of the time QQQ moves together with stocks with S&P 500. So even though it was underperforming, maybe a little bit still, I think this was a buying opportunity basically. And my subscribers did hopefully partake in the opportunity. Technology sector itself, XLK, all-time highs this week. So this is showing good appetite for risk. Financials, same thing. Very strong move on the heels of breakdown in bond prices. And still moving higher. But, when we get to bonds, I think we will see that there are some signs that maybe we'll see a pullback or at least a pause in the price appreciation for stocks. Consumer discretionary, this is as economically sensitive as it gets. Very strong move also to all-time highs. So all of this is pointing to good appetite for risk. Industrials, one of those examples when we came down exactly to support after a breakout, we had a throwback, came down exactly to support and just rallied off of it. Very strong move. And these are also extremely sensitive stocks, so this is a strong, good appetite for risk. We're now getting into some of the more defensive-oriented sectors. For example, healthcare. It's kind of somewhere in the middle between the offensive and defensive. So we're kind of in the middle there. And all-time highs were way back here. So far, no all-time highs. And but like I said, I think stocks in general have extremely high correlations to one another. You can put a correlation coefficient on this, and you can see that the correlations are very high. In other words, when S&P 500 is moving up, healthcare will likely follow. And here is one I want to spend some time on, the consumer staples, one of the weakest sectors right now, but this is a weekly chart and looks like we're showing some signs of bottoming action here. We had a couple of weeks at the bottom, and then looks like we were rallied off of the support that was built. So here is XLP, consumer staples on a daily time frame, and this one I just wanted to show that even though, for example, we had here a death cross, 50-day moving average moving below the 200-day moving average, that does not necessarily mean that we're going to see a collapse in prices. In fact, well, again, one of my more favorite indicators is intermediate term Bread's momentum oscillator. We can see we were in a negative territory, but looks like we're going into positive territory. So looks like we have room to run to the upside for XLP, the consumer staples. So we could see at least a pause in the market, and maybe the staples and the healthcare will catch up, and possibly utilities and the real estate. So here is this is XLP, but here is a sector which we did not hit all-time highs. This is a materials sector. We're still kind of getting close to all-time highs, but if we go to the equal weight materials, we did hit all-time highs. So again, another offensive sector hitting all-time highs. Here's utilities. We kind of came down relatively hard, but these are all-time highs. So, looks like possibly are bottoming out here. And if I'm correct, and we'll get to bonds, if I'm correct, and bonds will at least stabilize for now, utilities will certainly benefit. And then I wanted to show real estate. Here is real estate. Also very similar to utilities. We came down relatively hard from all-time highs, but looks like we're showing some signs of bottoming action here. Even energy, one of the least loved sectors, maybe we are breaking out above resistance here, and this was resistance here. Maybe we're breaking out to above resistance, and these are 52-week highs. So it's possible, it's possible that energy companies are going to also can contribute to the rally. Now, energy companies don't really contribute much to the overall S&P 500. It's about, I think, 6% of the total S&P 500 capitalization, but still, it is part of the market. Finally, I want to show again RSP, which is a equal weight S&P 500, and in this ETF, all 500 stocks are weighted equally. So you can see that Apple and ExxonMobil are nowhere near the top 10%. You can see it also hit all-time highs. So to summarize, stocks are very bullish. So any pullback should be viewed as a buying opportunity, in my opinion. In fact, my subscribers did hopefully take advantage. Me, myself, I did take advantage of that, and we went ahead and bought before the elections. Okay, here is a bonds, the 20-plus year Treasury bond fund. This one came from all-time highs and came down relatively hard. And it's possible that bonds are now in a bear market. There's a stronger and stronger case for that to be. Now, having said that, looks like we are showing signs of bottoming action here. Looks like we had a hollow candle here. Um, and so far the lower prices, we have not seen them. We'll see. Just one candle in isolation is kind of difficult to judge if this is indeed the bottom, but we came down relatively hard, and a counter trend, possibly counter trend rally in TLT would make sense at this point. Here is that same chart on the weekly time frame. Looks like we had a clear support break here from all-time highs, clear support break. There was another support here at 125, also broken, and now we're below that support. So looks like we had this could be like a hammer candlestick on a weekly time frame. So maybe we'll hold support here and at least attempt to rally. And this could be like maybe a rally in the rising wedge formation. Again, I think this could be now a bearish chart, and it may make more sense to short it than to go long. Here's AGG, the more diversified bond ETF. This one you can see that the 50-day is still above the 200-day. On this one, we already had a death cross here. And AGG is just less volatile than TLT. Also similar, possibly a pin bar here. We could see maybe this is a bottom in action as well. Maybe we'll see a rally. So this one is not as clear. It doesn't look like a hammer candlestick. And basically we are retesting this breakout. So the breakout here at 107.75, and we came down as low as 107.92. So looks like we are retesting this breakout, and this is a decent support level. So I would not be surprised if we hold support here for at least a little while and possibly even rally from here. Here is a municipal bond, and this one was the first to break support here. Pointed it out in the beginning of October, and we just unraveled completely. And these are indeed 52-week lows. So you can see the low was 107.62, even below the June lows of 2015. So these are multi-year lows. Oh, I'm sorry to say that. These are November lows, so 52-week lows, I meant to say, yeah. So, municipal bonds were the first one to run to the downside. But also they're sort of oversold, so we could see a general like bottom in action maybe in bonds, and maybe we'll see a rally, or at least an attempt at the rally. Here's the junk bonds, and junk bonds correlate highly to the general market, this S&P 500. They're mostly spend their correlation in a positive territory. These are all-time highs. By the way, these are also total return, so this includes dividends. So these are all-time highs, and this is basically good for the general bond market. So looks like for now this support was reaffirmed, and we bounced off of it. And junk bonds, same thing on a weekly time frame. Here's the support from 3505. Looks like we so far have held it, and these are all-time highs. So by extension, this is very much a bullish chart still. And you can see that correlation is high to the general stock market. So all-time highs or moving junk bonds moving to the upside is good for the stock market in general. Okay, here is the US dollar on a daily time frame. Really extremely strong move here. These are election lows here, and then we made 13 plus year high. So very extremely strong move basically, and it looks like we have a breakout above this level, but the more importantly, I'll show in the next chart, we have a breakout above the 100-point level. Euro is hitting 52-week lows, yen is under pressure, and pound of course was also at 30 plus year lows. Here's that same chart on the weekly time frame, and if you listen to some of my videos, this is going back several years, and I kept pointing the same level over and over, this 100.6.7 level and this 90 whatever 2 level or so. Basically a breakout out of this consolidation will determine the future movement of the dollar. Looks like we are getting this breakout right now. I'm still calling it a possible breakout because we could still unravel and come back maybe to to complete this cup and maybe a cup and handle or a double bottom pattern. But alternative scenario, we could just continue higher, and at the very least I see a about 9% move from the 100-point low, so like 109, around 109, possibly higher, because it just depends on where you measure it from. Maybe we'll measure it from here to here, then it's much higher breakout. Here is euro versus the US dollar. If you listen to some of my videos, I kept pointing that this is a bearish chart. We had a big rejection candle here and then just unraveled and never looked back. And these are 52-week lows right here. So on the weekly time frame for euro versus US dollar, same thing. I kept saying that this is a bearish chart. We had a big drop, a couple of big bounces. Just for a second, forget that this is a weekly chart. You can say that this is a 1-minute chart. So we had a big drop, a couple of bounces, and a couple of pretty obvious rejection candles right there, and then continued lower. So now we're at 52-week lows. This is a 52-week, a low from October, November of last year. It's 105.38. Just this week we hit 105.1, so we're at 52-week lows. I think we will re-challenge these lows as well from 2015, beginning of 2015. So it's possible we will break down from here and continue lower. And we can do an estimate of price to the downside. Maybe we can say that this depth of this pattern, very conservative estimate, maybe 7, maybe 8%. Lower from here for the euro. British pound versus a dollar. Again, same thing. This was oversold levels clearly. I said that we need to see a bounce higher. Well, looks like we are seeing it. Looks like the 50-day moving average is acting as resistance for now. But I think we may see a slightly higher, push slightly higher for the British pound to like 1.29, maybe even higher to 1.34. It just depends. I don't see it turning around just yet. In fact, here is the weekly chart, and this is clearly a bearish chart. I mean, this is 30 plus year lows. And in a bearish security, there is no telling how low it will go. It will just bounce slightly and then continue lower, and then continue lower. And here's the US dollar versus Japanese yen. If you watch some of my videos as early as like August of this year, I was saying that there seems to be a bottom in action in the US dollar versus Japanese yen. We saw a lot of bottoming. We had 1, 2, 3, 4, 5, 6, 7, 8, and possibly even a 9th candlestick on a weekly time frame, kind of congregate in the same area here at 100, 101. Finally, we had a big rejection spike here on the election night, and then it just pushed really strongly higher. So it looks like we are certainly no longer in a bear market for US dollar versus Japanese yen, and in this case US dollar is winning this battle. We're a bit overextended after a very strong 3 weeks, so again we could see a maybe some sideways consolidation, and in fact I think it would make sense for the dollar to consolidate its gains. Okay, moving on to the asset class pretty much everybody wants to know about. This is gold on the daily time frame, but I removed the price itself and I only left the 50-day and the 200-day moving average in place of it. This is going back to 1982, so it's a very long-term chart. Now again, one of the easiest techniques to see if the security is bullish or bearish is to see whether or not 50-day moving average is above the 200-day moving average. If the 50-day is above the 200, we'll say that the security is bullish and vice versa. However, there are those annoying whipsaws when we see a crossover, yet price just continues in the direction that was originally before the crossover. So I was very not unsatisfied with this system, and I was looking to develop my own. So I did develop my own. I developed gold breadth index, which looks not only at gold itself, but also at the gold miners. And I look at some of the parameters that gold miners produce and devise the system, which I call the gold breadth index. So in other words, basically when we see a move above 3.5 here in this line here, then we're going to say that we're in a bull market, and vice versa. If we see a move below 1.5, we're going to say that we're in a bear market for gold. Now this is a long-term chart, so those are relatively long-term markets. Works pretty good. It works about 75% of the time, so occasionally we do get whipsaws, but then most of the time we are in a it's in a decent system. So currently gold has been under pressure due to strong dollar, and we have, so gold breadth index basically has 3 parameters, which additionally have many more parameters going into it. But to make things simple, it looks like we have 2 of the parameters have become bearish, and one of them actually did this just on Friday. So it looks like we are now to 2. Before we were at 4, then 3, then now we're at 2. So one more parameter, if it drops off, and that parameter is this gold breadth index raw data, and it basically shows percentage of gold miners in an uptrend. We're not yet there, so technically we are still in a bull market, and actually, if I'm correct, dollar may take a pause, and this could mean a bit of a relief for gold and gold miners. So what I did is I went back and I saw some of the patterns where we saw, for example, we were at 3 and then we came down to 2, and whether or not we came down into a bear market. And I found one of the examples where we did come down from, in the gold breadth things, we came down from 4 into 3 and then to 2. And then whether or not we were already in a bear market by then. So here is an example from 1995, from October 1995, where we had gold breadth index came down from 4 to 2. But the gold breadth index, the percentage of stocks in an uptrend, percentage of stocks in the GDX in an uptrend, we're not yet in a bear market. We're still at 88 at this point, and I wanted to see what happened afterwards, so we can fast forward since we already have the data. We fast forward a little bit forward, and we can see that. Let me load the chart. Actually, we did not continue that much lower. I mean, gold breadth, the percentage of stocks in the uptrend dropped a little further, but you can see that it didn't go further. In other words, the bear market was not officially called at that point. In fact, we continued to bottom out, and then eventually, in mid 1990, in the beginning of 1996, we actually rallied. So. I'm not going to say that we're 100% currently in a bear market, because one of the indicators is not yet there. So it's possible that we're going to bottom out. In fact, let's go look at the current market right now. This is November 2016, and you can see that that same gold breadth index has dropped into to the point of, well, at 2. It was at 4, 3, and then at 2. Now, again, so far, the percentage of stocks on an uptrend did not drop into the bearish threshold. So I cannot 100% say that we are in a bear market for gold. In fact, we're somewhat oversold after this quite a significant move for gold and gold miners. So a rally, well, at the very least, we need to see a pause in appreciation of the dollar, and this will absolutely positively put relief on the gold miners and gold itself. Here's gold on a daily time frame. It's a little bit busy, but basically we have 3 support levels here, resistance supports. So here we had a breakout, but now we had a breakdown. So this is now resistance, and we had a reaffirmed resistance here. Another support level was right here at 1240, 1250. We clearly broke that as well. Kind of continued sideways, and we had another very important support. I call this critical support at 1201. So we broke that as well on Wednesday and Friday. So so far we have 3 support breaks. And another piece of the puzzle is this 50-day moving average below the 200. But like I said, I mean, we should put some some weight into this, but I wouldn't put all of your weight into this. So it's just one of the pieces of the puzzle. So we are somewhat oversold. So it's possible we will kind of bottom out, and maybe we'll see a bounce. A bounce that could take us to, let's say, 1250. Because this support, even though it was broken, hasn't been retested basically. So it's possible we will retest it and be rejected. In that case, absolutely we will see lower prices and almost guarantee a bear market. But we have not yet retested this broken support. We have also not really retested this broken support. So it's possible we will get back here or here and attempt to retest it. So gold may see price appreciation, especially if the dollar holds support. Or rather, if the dollar does not appreciate too much. Here's gold on a weekly time frame, same gold breadth index on the weekly time frame. For now, looks like we are in a bull market, but who knows? Maybe this is a head and shoulder pattern, and we're already below the shoulder line. It's possible. Here's that same thing on the same chart on the gold on the weekly time frame. This is the level I kept talking about, 1200. Looks like we broke that support level and now are below it. And then we'll see where it goes. See here we had a support break, a retest of that support break. And this retest actually took shape of a rising wedge. This is the rising wedge, those white candles. And then we were rejected and we saw a price decline lower. And here's gold miners ETF, GDX. This one is nice because we could see a bunch of divergences that I kept pointing out. We had this divergence that actually worked out, and we saw lower prices. We saw this divergence here, higher prices here on the chart, but lower prices on the advanced decline lines. It also worked out. We have another divergence that has not yet completely cleared out yet. We saw a lower low here, a higher low here. Well, you can see that I was counting it towards this low, but we still see lower lows in the advanced decline lines. So we will either continue lower or possibly will hold support here, because it looks like we have a couple of attempts to hold support here at 2013, 2014 area. Looks like maybe these are hammer-like candlesticks. So it's possible again that we will hold support here. Maybe we'll bounce. Where will we bounce? At, well, I guess 2250 is first level to watch, and then the level maybe around here. It's hard to say where, but you know, we have several things happening at the 23, 20, you know, $5 area. We have 50-day, 200-day moving average, support lines from this two touches, and a broken support right here. So there's a lot of things happening in this area. So it's possible we'll maybe at least attempt to bottom and maybe we'll rally to 23, 24. That's provided that dollar does not appreciate in price higher. Hey, here's oil and a daily time frame. So back here in October, we were rejected at around $52 or so, and moved lower. Here we had bottom in action. We had a spike lower, another spike lower, and then a rally. Where is this going? Very difficult to say. For the week, basically we went nowhere. We kind of traded sideways, but now there's this rejection spike at the top. Maybe this is already a rejection spike. It's possible, and maybe we'll just roll over and head lower. I looked up what the cost of producing a barrel of oil. You know, United States producers, not bad. You know, 20, what is it, 23, $24. So I think we're pretty much very competitive. So even if prices drop to, you know, $25, then United States producers still will be in business, and most likely there will be consolidations, and those that are, have higher producing costs, then they will be bought out by those who have lower producing costs. So um, I think the United States producers can pretty much outproduce anybody in the world. Yeah, I know that some of the countries here, they have even lower production costs, but you know, they are already talking about cutting production, and that means that such low prices are just not good for Saudi Arabia and some of the other producers in OPEC. So I think the oil is still I think it's still pretty much bearish. I think we may still see rejection spikes and continuation lower. Natural gas had a very good week. I pointed out basically that we are attempting to bottom out, and this is a major resistance area that basically turned support, and we came down almost there a couple of times, and this was another one of those. We came down pretty hard, and then basically we rallied 12% this week. So hopefully my subscribers have a position open. I have a position open in natural gas. I opened it, I want to say somewhere around here. I don't remember exactly, but it's gaining nicely. So we're again approaching 52-week highs. I think natural gas is bullish currently, so we could see a breakout to fresh 52-week highs and maybe fill this gap and maybe even possibly this gap. Here's copper. Yeah, we had a pretty strong breakout. I think the copper is bullish right now, but the thing is that this is a very strong move and very basically vertical. So I don't know. it just feels like it's a bit overextended, honestly. Maybe we'll find resistance here and roll lower, but we need to see a deep pullback, and I want to say we'll see a deep, a deeper pullback to like, oh, I don't know, here, $2.30 maybe even. Then I'll become more interested, because right now it's just way overextended. I would never want to buy up here. Here's a weekly time frame for the same chart. Looks like we had a breakout and we came exactly to the resistance 1 level in the weekly chart. This is a pivot point. Came down, came up there, and like I said, I think we need to see a pullback. This is way too overextended for my taste. Anyways, if you like what you're hearing, please consider signing up at MasterChartsTrading.com, and please stay tuned on how to find us on the internet. Thanks a lot. Bye-bye. So I wanted to show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services which are live right now. So please consider signing up for the service. It's only $24.95 per month. Also, if you sign up for our mailing list, you get a discounted membership. You get to see what I'm buying and selling and which funds I'm looking at, potential buys, sells, etc. There's quite a bit of members-only content once you log in. There's a lot of information about risk control, which is actually extremely important for traders, because the preservation of capital is really one of the paramount to the success as in trading. There's quite a bit of psychology of videos, psychology of trading videos in the members only section as well. Also, I'm going to be starting a Dividend Aristocrats service. For now, it's free for the members that are logged in, that are already paying members. So that's another benefit to signing up soon. The blog section shows the previous posts and market videos, of course. Also, I've added a new section here, which is FAQs, and I do get quite a bit of questions about various, ideas and questions about the market. So if you do have a question, please don't hesitate to send it in. Send it here, and I'll be hopefully I'll be able to answer it for you. All right. Thanks for watching, and please consider signing up for the trailer services. Bye-bye.